Welcome to the Explainer. The Indian stock market, it's this huge world of opportunity, right? But let's be real. It can also feel like a total whirlwind of confusing signals, especially when you're starting out. It's just a constant flood of news, charts, and a million different opinions. So have you ever just felt lost? You're staring at a chart, wondering which way it's going to go next, and you just feel paralyzed by all the noise. If that sounds familiar, trust me, you are definitely not alone. It's a super common feeling. But what if you could just cut right through it all? Well, here's the secret. The pros, the really successful ones, they don't have a magic crystal ball. They're not just getting lucky. What they have is a system, a specific set of tools they use to analyze the market and make smart, high-probability decisions. And in this explainer, we're going to open up that exact toolkit. All right, let's dive into our very first tool. This one is probably the most fundamental of them all. We're talking about support and resistance. Seriously, think of this as the map for your entire trading journey. It is the absolute backbone of technical analysis. Now, the key thing to get here is that these are not just some random lines we draw on a chart. Support is a price floor, a level where buyers are like, okay, this is cheap enough, and they step in. Resistance, on the other hand, is the ceiling where sellers start taking their profits. You're literally looking at psychological battlegrounds where you can see the market's mood shift. So how do we actually find these levels? Well, pros look for the big turning points, the swing highs and lows on bigger charts like the daily or weekly. But here's the real pro tip. Think in zones, not perfect little lines. Getting too precise is a classic rookie mistake. So for an index like the Nifty, that zone might be 20, maybe even 40 points wide. And hey, if a level shows up on both the daily and the weekly chart, you can bet that's a much stronger level. And here's what that looks like in the real world. Just look at this chart. See how the price respects these areas? It bounces off that support floor and gets turned away at the resistance ceiling. Using this map gives you so much clarity and helps you spot those high probability spots where you can actually plan a trade. Okay, so if support and resistance is our map, our next tool, volume, is kind of like the market's traffic report. It tells us how much oomph, how much conviction is actually behind a price move. It confirms what we're seeing on our map. So why is volume such a big deal? Because the big players, the institutional smart money, they can't hide their footprints. It's just impossible. When a massive institution, think LIC or a huge mutual fund, buys or sells a ton of stock, it shows up as a giant spike in volume. That's our clue that something important is going down. And the relationship here is simple, but it is so powerful. Look, when the price goes up on really high volume, that's a strong signal that institutions are buying. Super bullish. But what if the price inches up, but the volume is just kind of weak? You got to be careful. That could just be smaller retail traders, the weak hands, and that move might fizzle out pretty fast. The same logic works in reverse for falling prices. Now, this is where the magic really happens. Let's put it all together. Imagine you spot a strong, bullish candle pattern right at a key support level that we identified earlier. And at the same time, you see a massive surge in volume. Boom. That is your triple confirmation. That's a high conviction setup where the smart money is basically telling you they agree with your analysis. All right, we have our map and our traffic report. Now it's time to add some precision instruments to the toolkit. Think of these next tools as your GPS, helping you pinpoint opportunities with some serious accuracy. First up, the 52-week high and low. These levels are incredibly powerful for one simple reason. Everybody is watching them. From news channels to big trading desks, these numbers are burned into the market's collective memory. So when a stock gets close to them, psychology kicks in, and you often see some very predictable reactions. And traders use these levels in all kinds of ways. Momentum traders, for instance, might jump on a stock like Reliance Industries the second it breaks a new 52-week high, betting that upward trend is going to continue. On the other side of the coin, a value investor might see a solid company like Infosys hitting its 52-week low and think, aha, that's a bargain. But what about those support and resistance levels that aren't so obvious? The ones that seem to pop up out of nowhere?
That is where a fascinating tool called Fibonacci retracement comes in. After a stock makes a big move, it often pulls back to these predictable percentage levels. The big ones are 38.2%, 50%, and 61.8%. Just think of them as invisible tripwires for price, giving you super precise areas to watch for a bounce or a reversal.
Okay, we've covered some really powerful tools for analysis. But I gotta be honest with you, none of them matter. Not a single one. If you don't have the most critical part of the toolkit locked down, your safety features, your seatbelt, and your brakes. This is all about protecting your capital, and it is absolutely non-negotiable.
And the single most important rule for survival in the market is the 2% rule. Now, this gets misunderstood all the time. This does not mean you only invest 2% of your money. It means that the maximum loss you are willing to accept on any single trade should never be more than 2% of your entire portfolio. This is what ensures that even a nasty string of losses won't knock you out of the game. So here's how you actually put that rule to work. Before you invest a single rupee, before you even think about clicking that buy button, you have your game plan laid out. You know your exact entry price, you know your stop loss, the point where you admit you're wrong and get out, and you know your target, where you'll take your profits. Having this plan before the trade is what separates pros from amateurs. It takes the emotion out of it.
And building right on top of that, pros only take trades that have a good reward-to-risk ratio. So look at this example. The potential risk here is 40 cents per share, but the potential reward? It's 80 cents. That's a 2-to-1 ratio. This simple math is so powerful, it means your winning trades are twice as big as your losing ones. You can actually be profitable even if you're only right half the time.
So, there you have it. We've just filled our toolkit with professional-grade instruments for tackling the Indian market. Let's do a quick recap, and then I'll reveal the final and most important tool of them all. You now have the 4 essential parts of a professional toolkit. You've got your map, which is your support and resistance. You've got your traffic report, which is volume analysis. You have your precision GPS with 52-week levels and Fibonacci. And of course, you have your safety system with those rock-solid risk management rules. But here it is, the final piece of the puzzle. You can have the best toolkit in the entire world, but it is completely useless without the one tool that you can't find on any chart. And that tool is discipline. The discipline to follow your rules, the discipline to stick to your game plan, the discipline to manage your own fear and greed when real money is on the line. That is the ultimate key. So the real question isn't about the toolkit, it's about you. Do you have what it takes to use it? Thanks for joining us on The Explainer.